The tax effect on the timing difference is termed as deferred tax, which literally means taxes that are to be deferred. It is recorded in the balance sheet of a company if there are chances of a reduced or increased tax liability in the future. There are specifically two types of deferred tax asset and deferred tax liability. A deferred tax asset is an item on a company's balance sheet that reduces its taxable income in the future. Such a line asset can be found when a business overpays its taxes. This money will eventually be returned to the business in the form of tax relief. Therefore, the overpayment becomes an asset to the company. On the other hand, a deferred tax liability is a listing on a company's balance sheet that records taxes that are owed but are not due to be paid until a future date. This liability is deferred due to difference in timing between when the tax was accrued and when it is due to be paid. For example, it might reflect a taxable transaction such as installment sale that took place on a certain date, but the taxes will not be due until a later date. It is important to recognize deferred tax liabilities because it helps the company to be prepared for future expenses and plan its business operations accordingly. Similarly, it is prudent to recognize deferred tax assets because it can help reduce tax liabilities in the future.